We'll be looking at how we see the outlook for 2026. We're going to start with Thomas here, just picking up on some of the key elements that we think are particularly relevant for this in terms of the ULI PwC Emerging Trends report, because that will add some of the content as well for a little bit of the discussion, because we can pick up on some of those trends and then see how we're seeing them from a different perspective.
Okay, so good morning. Welcome to our PwC tower here. And again, thanks Richard and team for coming over, orchestrating the event, moderating the panel later on, and definitely I will put my wish list for the next year to Thorsten and team. So what I will do is I give a quick overview on the emerging trends in real estate. We are doing this research for quite a while in a long-standing cooperation with the Urban Land Institute. As every year, we have a series of 3, or at the end of the day, 4 reports globally. So we are starting usually early November with the Americas Emerging Trend Report, then the European report, where I will show the key results, and then we have the Asia Pac report towards usually end of November. So it's a global view. And then at MIPIM, we are presenting a global combination update, the global outlook for the market. And how is it done? It's not let's say, an analytical report. It's based on interviews. So usually I think in Europe, we interviewed 1,200 market participants and try to bring the general outlook sentiment for 2026 and also some trends towards the midterm, so 2 to 5 years. But usually it's a question, what does the market participant think about the next year, the next 12 to 18 months? And that's the summary I will show. So again, it's not an analytical report. It's based really on deep dive interviews with more than 1,000 market participants. So it always starts with a general chapter about the overall sentiment, which is of course a bit generic, difficult to get, but to get a feeling what the market sentiment is. And here you clearly see in the curves that we are on a very good track compared with the last years, coming here from the low in 2023, 24 with the war, the interest rates, inflation's picking up, and now you see that the business profitability outlook for next year is pretty good. It has grown compared to the last year. The business confidence is a bit lower, but it's still on a pretty high level. And I think the good news is that the business headcount sentiment is the firms are willing to invest in people, which is always a platform. Yes, we have a big discussion about how AI can not mitigate, but how can this create synergies on booming the business. So if you add up this positive business headcount sentiment plus AI, it feels that this is a pretty positive view on the next 1 or 2 years. Of course, the war for talent topic, it's still around if you can really find the right people. But it's also, and that's also one sentiment, it's a big education program we need for the industry towards the next year, especially in this AI area and digitization, where we are not, I'm talking that for more than a decade now, we are not the front runners. I think we will not be it in future, but I think there's so much efficiency potential we can grow. And looking at the key concerns which were mentioned, and usually this is often in the past years more about key real estate topics. It was about, wow, we don't know about office. We have problems with construction costs, with construction capability. And this year, which is not completely different than the last 2 years, but the general sentiment and the concerns are, and that's no surprise, it's all about geopolitics and instability. It's about the macroeconomic growth, the global growth, especially the European growth. And talking about Germany especially, it's also the question, how do we get the growth back? There are some initiatives started which might have, and hopefully, and I think they will have a positive impact, but it's less about real estate or real assets problems we are facing. So you see still construction costs is a bit of a concern, but talking to developers here, they say the problem is not that we don't get building construction capacities and prices are also on a good level. We need the push to really get the development out of the ground. But a lot of risks we have seen the last 2 or 3 years are mitigated now. Yeah. And then combined, the political instability is, of course, the biggest concern. Political instability and deglobalization is a big thing which as a built environment representative, it also comes with a big opportunity to really reshaping supply chains. It's still about logistics. It's about digital infrastructure, where we are, as a continent, still far behind compared with other countries. But that's something we will discuss. And the general, and I didn't mention the key message from the report is that it's called facing reality. That's a key message from the Europe report. And looking also at the Americas report, the key message was navigating the fog. So it's coming from 2-3 years where we don't know what's happening. Let's wait and see. It's now really we have to do something. There are opportunities. We have to pick them up. So facing reality is a key message, and see more the opportunities and not waiting for, I don't know, a stabilization in the geopolitical environment that will remain unstable for the next years for sure. Market volumes, you all know these curves. We are coming from some years ago, big transaction markets. 2025 was a bit more better than 2024, where in fact nothing happened in the European markets. But we also see that and the key blocker, at least what I heard in my interviews and a lot of market participants, that the banks are still sitting on their books and don't want to, let's say, doing an active restructuring. So that's a sentiment starting later at Expo. I had a lot of discussions with investors saying, yes, banks are moving slightly. There won't be a big non-performing loan wave, but we see that the NPL quotas on balance sheets of the banks are growing. So there is now more willingness to work actively on the situations, and this also gives a bit of liquidity in the market. On the other side, we see that interest rates are stabilizing out. The general market fundamentals on the asset types. So we know that resi living is a big space where we need more investments. The underlying rental situation is good. So there's some key messages here that give the general positive outlook for 2026, that we will see more liquidity in 2026, not like in 2022 for sure, but it's slightly improving, also coming from the refinancing situation. Banks are more actively working on their situations. And one key message also came clearly out: the capital is there. Even if you are in a fundraising mode, German LPs are still tricky, and they will remain tricky for the next years. But in general, there is family office money around. There's private equity money around for, of course, the higher risk universe. So it's not the equity side that limits the market. And on the other hand, we also see the clear move that the private debt is more and more active, less for the, let's say, for the core activities, but more for the higher risk situations. I think we will also discuss that. So capital is not the problem. It's really about the willingness to invest and get the business cases done and put that together. I think that's also good news for the European market. Coming at markets, we always ask what are the favorite markets. And the clear message this year, like in the last years, in uncertain times, we always look at the big liquid transparent markets. So no surprise that London for Europe and Paris are dominating this curve. Madrid, of course, number 2, not a market in size and volume like London and Paris, but it's from the fundamental economic growth. So the government down there in Iberia have done a good job the last years already. Now we see the growth by 3%. Also the outlook for next year. In the situation, they also worked through their bank balance sheets. All the NPL portfolios coming still from the financial crisis are more or less worked out. There's still something chasing around. But we are now discussing growth opportunities, growth platforms in Spain as well in Portugal. But on the other hand, the good news, Germany is also still on the agenda. So Berlin is still around. It's, of course, a bigger market. And you have on a lower level. You have Hamburg, Frankfurt, and Munich also here. Of course, always with the discussion, how do we get growth back in Germany? But we are still under the top 10, which is, I think, good news. One big thing from the due diligence list, which country can I invest or which city can I invest, which was clearly stated in several interviews, is that investors are looking for markets with a clear legal framework, with the democratic framework, coming from the general global discussion in Americas, partly also in Asia Pac. So that was also a positive message into Europe, that we have some good, even if now in the new geopolitical strategy of the US, it reads a bit differently. But we as Europe still feel, and I think we are still an open continent, and we are already seeing people moving into Europe, leaving Americas, which is also big opportunities. And that's where also our strengths as Europe comes out, that our cities are much more livable than other cities around the world. Of course, there's still a lot of homework to do, but people really see this value more and more of Europe, that it's a good continent. Yeah? Whatever good means, but for some of them, it feels better than other parts of the world right now. The sectors to watch, also a trend we've seen for quite a while. It's, yes, real estate, and it's must be clear on this slide, because there are always questions come up. Where's office? We're heavily invested in office. Why is office not on the list? It's, I think, the message, where would I invest and where do I see fundamentally great growth opportunities, even knowing that we are partly in niche markets here. Yeah, but that's the key message here, and that's the trend towards real assets, so away from pure hardcore real estate, more into the infrastructure space. So data center is, I think, number one for 4 or 5 years now. And we have an interesting discussion, hopefully, on data center, because it's really, is it a hype or not, or what's going on? 5 years ago, the sentiment was, yeah, it's a niche and it's not really relevant. But now looking at a data center, it's a $1 billion investment. So there's really volume behind it, but it's an interesting space where we really have to know. Second part is all the synergies between real estate and energy. So making real estate part of the energy grid. We all know with the growing solar and wind dependence, which is a good move. We need to get the volatility out of the market. So a lot of discussions, how can I be a producer of energy, but also part of the storage system to stabilize this business and making money with it at the end of the day. And then the other sentiments, more or less, it's all about living, co-living, student housing, senior living, serviced apartments, and classical affordable housing. So that's a big trend, and that's also not in Europe, it's globally. We are short on living. Yeah, the living space, especially in the urban areas. Yeah, that's at a discussion when we presented the emerging trends the first time some weeks ago here in Frankfurt. There was a discussion of if we just move out 50 kilometers out of Frankfurt, everything is empty. Not everything is empty, but there's enough space. Should it be more discussion about the logistics and the transport system? But the urban areas are undersupplied with demand, and it's getting more and more social pressure because people just can't afford it. I think this week there was a new study, can't remember, that Lisbon, nobody can afford, no residentials in Lisbon can afford housing in Lisbon anymore. Yeah, it's all about the tourists, etc. They can pay higher, but there's a bit of social pressure. Then the other two big topics is about ESG. We're coming from a phase where ESG was always number one, and now with Omnibus coming up, there is a bit of more pragmatism. I think the sentiment is, what we heard is, yes, ESG is still on the agenda. It's not number one, but we have to balance out. We have to show the business cases, etc., which is partly a good thing. I personally think it will come back with a net flooding wave and heat wave. I think we will have the discussion back on the table. And the second big topic is the use of AI that we might also discuss in the panel later on. Of course, the use of, do you use AI already actively, has grown the number from 35 to 75%. But it's always an interesting discussion. What do we mean with that? Yeah, is it using a co-pilot on a corporate level, or do we really AI deeply on the asset level already? But that's an interesting discussion. But we are on a journey altogether. Nobody has the right answer, what's right or wrong with AI. but I think we all feel that there's a big change coming up, and we already feel it. Yeah, and then reflecting again, as I said already, real estate and real asset plays a crucial role in the attractiveness of the continent. And looking at the Draghi paper he published some months ago, where a lot of people were confused and saying, well, big money we have to spend. But real assets is really a big topic in there. So it's all about, and we picked the key messages from this Draghi report. So affordable workforce housing is highly rated, data center, digital infrastructure, and just the logistics and distribution. And if you go down the list, it's all somehow related. Deglobalization, get Europe in a standalone position, and making it attractive for people and companies to really invest there. And that's a big journey where we can see it as a big opportunity, or we should see it. I'm not talking about defense space. We're seeing some defense real estate funds picking up now, investing in logistics, for defense purposes. So there's so much sentiment where we can have a positive role and so much opportunities in the market. We just have to come out of, yes, I buy office and I buy retail. I think there's much more to do. And that's more or less the end of my presentation. So the key message, facing reality, challenging times, but all challenging times, transformative phases are always come with good opportunities. Capital is around. And the message here is following the big trends, the secular trends, driving value. And we always have to be, let's say, proud that we can be a really relevant part of the journey into a more competitive Europe, which is on the political agenda. So thank you for the time and giving me the opportunity to present the results. You can download it from the web. I think it's on the homepage. Many thanks again, and back to Richard.
Let's start with quick introductions. Thomas, you didn't actually say who you were at the beginning, did you? So let's do 30 seconds on who everybody is. We'll start with you, Thomas, and we'll work our way around this way. Thomas.
I think you introduced me, Richard, but yes, I'm Thomas, a partner here located in Frankfurt, having the honor of leading the German real asset team and the global real estate team at PwC. So bringing all the data points and connectivity client work out for the global clients together at PwC.
Perfect. Susanne.
Good morning, everybody. I'm Susanne Eickermann-Riepe. For me, it's a little bit like coming home, because I was for 30 years with PwC, also heading the German real estate market, and now I'm becoming the senior vice president at RICS next year. I'm chairing at the moment the European board, and hopefully I will be 2028 the president of RICS.
Yes, great. Congratulations on that as well. Super. Dominik.
Dominik Brambring. I'm representing Periskop Opportunities here. I'm a managing partner. Periskop Opportunities is part of Periskop Group, which is a boutique asset manager or investment manager, originally focused on land development around Berlin mainly, and then involved into other asset classes such as logistics, living, and now also opportunistic and value-add strategies that I'm leading.
Great, thank you. Christian.
My name is Christian Kaiser. I am the country manager of EFM, and EFM is a PropTech company founded in the year 2000. And we have supported all of our clients in public and private areas. We are managing around 190 million square meters, actually, with 1 million workstations and an asset volume of roughly 5 billion. And today I'm here to give you an overview about the PropTech market in Germany.
Great, thank you. Yep.
Good morning, it's Andreas Walter from Yester and Morrow. I'm the founding partner. We are a boutique law firm fully focusing on real estate and infrastructure. We only do the structuring on AIFs in that sector because we think the cause-effect relationships are the key drivers for clients to get the benefit out of those markets.
Great. Let's start, I suppose, with just some of the key trends. Any responses to what you've seen in the presentation from Thomas? Maybe let's start with you, because I know as well, Susanne, that the RICS do quite a number of sentiment ones. So it'd be interesting to see where that connects with what Thomas is seeing in the market, if there's any differences you're seeing?
Yeah, I think overall Europe is better than we are talking about here in Germany. Yeah, it's a lot of pessimism, not optimism in the market. But what I can really agree on is that we have several countries in Europe which are doing really good. So from our 3 months sentiment report, I can tell you that Spain is heading these sentiment with plus 30 points. Then you see Greece with plus 90. And I must say at the end France with minus 40 and Germany with minus 19. So you see a big spread, and we definitely have a south-north divide. So, and we also see a little bit of east-west divide because CE is really doing good. We see also that globally we have a lot of differences. So we see that Middle East and Africa are doing good. They have a lot of money. They invest a lot. APEC has some really big topics with China. They are struggling a little bit. And I think in the UK we also see a little bit of downsizing because the government has stopped a lot of projects. So it's a mixed picture, but overall I can agree to what you say. And I also see that the asset classes, the alternative asset classes, which we also view in our monitor, are doing very well in capital value, in rent expectations. But we have really to look at infrastructure. Yeah, infrastructure is not like real estate. It's a difference, and a lot of money is flowing into infrastructure because of the stable returns and cash flows and so on. As long as we don't see the exit value in the real estate sector, yeah, it will be really difficult to make some money out of the historical markets. Yeah, definitely we see suffering from the secondary markets in office, in retail, in everything. So I'm really hopeful that the industry is finding new solutions for the secondary markets because the top markets are doing well.
Okay, good. Lots of things to introduce here. And one thing that I am going to say is if anybody's looking at me saying, I would like to come in, Richard, on this point, just do. Don't ask for permission, come in. Dominik, it'd be interesting to pick up, and I'd be interested to get everybody's views on this as well. Feel free to pick up on anything that's been said so far. But also, how do we see things like macro interest rates, those kinds of things, which of course are big drivers of the sector? How do you see those for 2026?
I mean, we have seen a lot of macro over the year, and it was not always positive for our market. To be honest, I mean, beginning of the year we started off with a new sentiment. Now let's get the market going. Everyone was positive that 25 will see a trend, a positive trend. We've seen the trough in some of the sectors for sure, like residential, for example. But then Donald Trump decided to come with his tariffs in April that actually put on the brakes on some of the sentiments really. So the macro, and now we are also, we expected a lot. Let's now look at Germany. We expected a lot from the government, the infrastructure package. But now there's, I think, a slight disappointment in the effects we see. Maybe we're a bit too impatient, and we'll see that next year. I'm pretty sure in some of the sectors we will, but these are more infrastructure type sectors, not real estate necessarily, or we need to redefine real estate in some parts. That's something we do, for example, at Periskop. So we see ourselves as the intersection of real estate and infrastructure in some asset classes. But that's with that said, I'm a bit concerned that the macro view is turning slightly negative again, like seeing Jamie Dimon, and he's not in the camp of Donald Trump. So he's very concerned about Europe and the growth prospects. And we need to change that sentiment. So that's the macro view on interest rates. Long-term interest rates are ticking up again, which has also to do with the situation of European finances. There's a lot of uncertainty. The government financing is not sustainable in some parts, so and that shows in the capital markets. So we see interest rates on the long end going up to 3% again, and I think they're going to stay there. So I don't expect any help from yield compression or interest rates coming down. So we need to focus on sectors where we still see rental growth prospects.
Okay, good. And Andreas, feel free to pick up some of that. I'm going to come to you in a second, Christian, to pick up on how we're seeing technology, AI beginning to influence that. But Andreas, just pick up on any of those, and also some of the capital flows things. I think it was interesting that Thomas was saying that capital is still very much there. It may not have been the original sources of capital we were seeing in Europe, but you're seeing a lot of private wealth. You're seeing different players in the market. What's your sense of that?
Well, if we also pick up on what we've just heard, I think we see that there are markets in a different stage. We see those markets that have already been socially transformed. If we look at Greece, if we look at Spain, they have gone through the rough patch in the past, and they have developed a strength out of going through that patch. And then if we see the other countries, especially also the German market, we are still not there. We haven't gone through those rough reforms like others. I mean, we were great advising Greece and saying how they should reform their social system to come up with a new market-driven sentiment that we now, a couple of years later, see also deploying back in the real estate market. And we have the same if we look at our markets. We are sitting on an old pile of commercial real estate, which is no longer in use because we simply have a structural decline in back and middle office space necessity due to digitalization, due to the market improvement of an AI. What is missing currently is to say, how do we shape that? It's not just a cycle. It is a fundamental shift in how we work and what we use offices for. So how do we shift and transform this as an industry? And I think if we look at these effects, then we know that there needs to be the setback, there needs to be the reform, and then picking up on that with the new way how we as a real estate industry supply a demand to then come to a competitive Europe.
Perhaps one thing to add on, I generally agree, but picking up on the office space, because it's still so relevant for a lot of German institutional portfolios. That was one, I didn't mention it, it was a significant shift from the last year's interviews, that office is at the end of the day investable again. The year before, no office, no way, Corona, no developments, etc. But now, office is back on the agenda. Also speaking with the international capital, they say, yeah, it's still around, with a but. And we see the market developments, the real core office, the newly constructed or renovated ones with ticking the ESG credentials, giving this experience, they are doing pretty well. Yeah, they are doing from a leasing perspective, but that's a pure quality play. Yeah, it's, I don't know, probably the 10% or 15 or 20% of the market are doing not so bad in office, but everything that's outside, that's a massive shift, still a negative sentiment. But we will see, I'm pretty sure that we will see developments coming back the next 2 or 3 years for the really great locations, also for office. Yeah.
There we have no disagreement, but then from our perspective, it's a different question what you do there. The office becomes the place of identification. It builds company culture, it gives you the ability to represent, but it's no longer the space where you need to be 5 days a week, working from 8 or 9 to 5 in a middle and back office situation. And that's exactly, the market spread is going up significantly. And now the real challenge is going to be, what are we going to do as an industry with those spaces which are not core, which don't provide that identification space, and how do we use them in a redefined market? And then the question is, what is the pricing stepping in there?
Christian, I would like to pick up a little bit on the capital flows and what we're seeing, if this is a question you can answer, which is what we're seeing in terms of capital flows, in terms of technology coming into Europe, because obviously that is a big driver as well, both of, economic success in some ways. So what are we seeing there, and how do you see some of these trends playing out? And feel free to pick up on that point about how we see that developing in terms of the office side as well.
Yeah, perhaps if we take a look to the German market data of the PropTech market, we see an interesting paradox, because we see on the one hand that the financial volumes are dropping or slowing down, and on the other hand we have reached a new high of active PropTech firms in Germany. So we have meanwhile over 1,300 active firms, and this is a success of growth of over 20% on year, and it re-secured us again the space in the top 10 global PropTech investment countries. In parallel, we know that these PropTechs are no longer a luxury, so it has evolved to become the research and development department of the German real estate sector. So in this area, I think PropTech is playing a crucial role for the future development of this. And if we take a look to the consolidation and technology returns, then we see that the market is projected to grow by 16% till 2030, and this will fuel up the M&A transactions on the market. And as well, we see that strategic partners and players are coming to the market, acquiring complete integrated platforms. And if we take a look to, for example, the managing category of property management and online search, we see revenues of roughly 44 billion with an investment of 40 billion, which shows the financial value. And if we look to the building category of construction and robotics, we see revenues of 21 billion with a little investment of just 6.5 billion. And this shows the financial returns, but as well it shows the demand from the market for AI-driven equipment and robotics. And I guess we see here a clear pattern that the next wave of PropTechs will be AI-driven, ESG supportive, and delivered as business-to-business SaaS model. And perhaps I'd like to pick up to the other topic of, let's say, in the context of big cities and neighborhoods, I think that we cannot use further on these old paradigm of static assets and rigid contracts. I think the people, the users in Germany, in Europe, and as well in the big cities are demanding for flexibility, they are demanding for collaboration, for services, and even to have a measurable impact. And as you said, and you said as well, the office turns to the hub of experiences where it is for collaboration and for learning. And I think our retail and education spaces must get much more flexible to support even the evolving needs of the users in the future. And I think, like our CEO always says, the space only matters if it serves people, and to serve, it must be able to listen, adapt, and evolve. And we are at the moment not on this point, and as well, we cannot do space as a service, which is emerging with Excel sheets and PDF contracts.
Yeah, but perhaps I just to support the message. I think our industry, Germany, whatever, globally, in Europe, definitely needs more innovation in construction, but also in the asset management. And we are doing also this PropTech maps for, I don't know how many. I think, Susanne, you even started that with Build World, and we also added a Tech for Impact map. So it's a good journey. I think there's so much innovation needed, and there are some good companies, definitely. But speaking to a lot of startups, if they knock at the door of the big asset managers, or it's still tough for them, to really open the doors, and the mentality is still, if I don't have to do it and show me the business case, why should I invest X, Y, Z? and I have to transform something, and it's not plug and play. So there's still a lot of concern, which is not good, because the inefficiency in our industry is still massive. Yeah? And there are some good, I think, good examples that have done a good job and help. I think we should definitely push more. And the second point is on capital, venture capital. I think we are good on angels. We are good in the starting phase. The growth stage, we don't have a capital market for that, and that's still a challenge. If you go at the growth stage, and we as a firm are also working a lot with PropTech PT1 in Berlin, and we're also invested in one of their funds. So we see some of these things. If it comes to the growth stage of the good ones that have proved they can do it, then they have to look at, I don't know, US capital, and then the things move away from Europe, and that's a shame, to be honest. Yeah.
Yeah, absolutely. And what I want to add in addition is that you said we cannot run the things how they are at the moment. We need more innovation. And I think this is a crucial point, that we need at the end a new operating system for the city and our working environments, which brings these things together. And we call this digital service governance, but later on I will talk a little bit about this, the solution for as an operating system.
Just to add, the legislator has identified that, and we are going to see some new legislative acts on VC capital funds to actually enable that growth phase. So there again in Germany, it's a long, slow process, but they've picked it up. Just as a positive outlook.
And let's pick up a little bit, Dominik. Do you see these kinds of trends playing into the opportunities? How do you see that? How do you work that out in terms of an investment strategy, or how that informs the opportunities?
Yeah, it's not necessarily to do with PropTech, but it has to do with innovation and redefining real estate in some way. I mean, we are concentrating on sectors, and there's no surprise, they all showed up on your board. It's modern living types, also including senior living types, not necessarily care, but senior living types that cater for the needs of the older population, barrier-free environments and so on. And also healthcare, healthcare assets that you could define as infrastructure, ambulatory care centers, for example. That's something we are looking at. But we definitely need some innovation, especially, and I don't necessarily see the innovation in technology as yet. It's more construction, which is obviously also technology driven in parts, but we need lower construction costs to come to the kind of yield on costs to attract that capital that is available. I mean, the capital that I see available at the moment is relatively expensive, and to create these kind of asset classes, these new asset classes that do not exist yet. So everyone is focused on, I buy the stuff, I fix it and sell it. I think this old mantra of the PE industry is somewhat obsolete. So we need to look at new asset classes and create these asset classes. We need to help the stressed government finances in a way, and create the infrastructure that we need for our society on the private sector, and we need innovation for that, for sure.
Can I step in on the construction side? Yesterday, I just launched here in Germany our sustainability report, and what we see from the construction side is that they really know that there is a CO2 problem, but they don't use CO2 for choosing materials. And there's also this old construction style which will not help us to create this new product or make it more efficient or make a better return on invest. So we definitely have a lack of innovation, and we must think about it. We as RACS also have to think about AI and all those calculations around the value of properties, and we are facing a lot of challenges, so that we are creating AI regulations and so on. I think we really have to look at all these systems which are on the way. By the way, do you really know that Italy has most of the new valuation models in place. So we are really looking around Europe who is doing what, and maybe we need a little bit more certification on that. Yeah. So what really brings the property value up? Because it's not all brown discount. Yeah. We are just talking from this pessimistic side. There are also some premiums, but we are not really focusing on that. Yeah. And if it comes to more innovation, we will see a lot of mm, challenges, but we also will see maybe some premium upgrades, yeah, when we look at new products.
Yeah, it's quite interesting. I was chairing the EPRA Sustainability Summit in London 2 weeks ago, and then last week I was in Paris for the Sea Change Summit. There was some interesting things came from that. One was a presentation from JLL, essentially saying that there was a big focus from what he could see in his global remit, a big focus here in regulation driving it, but actually in the US, it was much more opportunity driving it. So although the mood music in the US was not great, actually everybody was getting on with it because they were just investing in what they thought were going to be the next generation of buildings, which needed energy, needed to be sustainable, needed all of those elements. So they were just getting on with it. And there was a danger that Europe was actually focusing on the wrong part in a way, which was meeting the regulations as opposed to seeing the opportunity, which I thought was an interesting take on that. But certainly more people that I'm speaking to are about how do we make this, the argument is one in a sense, which is it needs to be there, but then how do we drive efficiencies? How do we focus more on energy? How do we decarbonize? How do we make this work? So that's quite an interesting area. Did you want?
And again, we are getting there. I mean, we see with the omnibus packages, we are stepping back from the pure thought of regulation as a compliant or explain approach that we had on the EU. And what is now the shift that we'll see, and we'll come to that later, I think, is that the core question of ESG is going to be, how do you define a resilient asset, which is then going to provide sustainable returns? And that's the new focus on ESG, having something which is immovable. So we need to face the situation on the ground where the plot is lying, make that asset resilient, and create sustainable returns out of that asset. And I think we see this, it's a slow shift, what we have exactly this slow shift also in the regulation.
Yeah, I must step in here because this discussion around the CSRD, the omnibus, we are not working around regulation. Yeah? We cannot hide behind regulation. We have to look what we need in the industry for the future. And everybody is looking at this regulation. Yeah. And I must say it's not good. Yeah, that only a few companies now have to report, but that's just reporting. That's not reality. Yeah? So at the end, it will be our innovation, our new products, which help us to rebuild the industry, yeah, in a new way. And the question also on ESG is, overall in the world, they are looking for the return on investment. And this must be a mind change, yeah. Do not invest because it's regulation. So what will be the return on investment on this transformation money? And this is a little bit more business driven than regulation driven.
So do we see this as a value driver now, that it's moved from being something that is a regulatory requirement or good for the planet, but actually is now may well still be good for the planet, but as a value driver?
Yeah, from my point of view, it's about materiality and not morality. Yeah. So you see new risk models coming up, and the European banks, yeah, are our better environment watchers than everybody else. So if you want to make a deal or make a development, you have to be sustainable and resilient. Otherwise, you will not get any money out of the system.
Yeah, maybe one comment on that. I was a bit surprised that we're saying it's either an opportunity or it's we concentrate on regulation. I think we need to do both. Yeah, we need to look at opportunities that are still meeting the regulations, because it's not going to get away. Yeah, just regulation is there to stay. I was a bit surprised that ESG has dropped in your league table to more or less the bottom. I'm not in that camp. I think if I look at opportunities, ESG is the main driver for exit liquidity, or one of the main drivers. If I haven't got the ESG credentials in my product, I'm not going to sell them to institutional money. So regulation is not going to go away. So it really is a strong driver of capital values at the end. So I need to consider them. Yeah.
Yeah, I was also surprised, but asking then the question back is, yeah, it's not so high on the agenda only because it's implemented, but sometimes it can just be an excuse to say, nah, we do it. But I think it's really implemented. As you said, and coming to FRICS also as a standard setter for valuation, I think if you can't prove these credentials, the valuations will be different and should be different. And perhaps one comment on, again, global, looking at that, Europe was always the driver of ESG, and being in other parts of the world, the people were always saying, well, you are doing a good job. Yes, you are driving it with regulation. It would be better if a market could solve the problem. But if the market can't do it because there is no CO2 price or biodiversity loss price, if that's not priced in, regulation needs to, at least at the beginning, help on that. And now we had Omnibus pulling a bit back. Hopefully that some market drivers are now solving the problems, focusing on it. But speaking 2 weeks ago in Singapore, there was also an ESG or resilient panel. It's not called ESG anymore. Resilience panel, and they are pushing hard in Asia back on that, and also in Americas. Yeah, it's not gone. It's just a different framing, more looking at the business case, which is good. At the end of the day, the market should solve it. But if the market is not properly pricing the risks of CO2 emission and all the other impacts real estate has on the environment, then your regulation has to do it.
Yeah, we also saw this drop on ESG in our sustainability report, but it was mostly impacted by the Americas. Yeah, they dropped from +30 to 11 or so. So, and that was impacting the global figure. If you look at Europe, you see that there is still high demand. It's not that dynamic what you see, because we are already at 70-80%. Yeah, so but in Europe it's still a number you have to touch.
Okay, good. And Christian, from your side, interested to pick up, what are we seeing in terms of some of the efficiencies from AI, from digital, supporting this area? If we're looking at digital twins, if we're looking at those kinds of areas, how much is the uptake here, and what can we expect going forward?
Perhaps if we take a look to this topic out of the PropTech classes, then I think we see this growth actually in the PropTech based on a clear strategic driver. And one driver is for sure the ESG topic. So we know, meanwhile, that ESG is getting the #1 pressure point for specific business models. On the other side, we know that it's no longer something nice to have. So at the end, it's a critical necessity even for investors, yeah, and stakeholders depending on the product. The other topic we see in the PropTech coming up is the AI topic. So absolutely, AI, or the market has decided that the artificial intelligence is the market transformer #1 in terms of ecological, economical, and digital transformation. And we see even with that a connection towards the urban context, because the PropTechs have solutions for the pressing needs that we see meanwhile inside of Berlin. And so from this perspective, I think in the PropTech, ESG, AI solutions are at the moment still the #1 topic.
Can I pick up on the AI solution? So I know AI is overall. Yeah. We have to look a little bit more on the details, because it's not only efficiency, it's also effectivity. And if you look on all the jobs at the Big Four or at the big brokers, this entry level is maybe no longer needed, and that this will be a problem to train people for the new solutions. And we have to find a way to make sure that we use AI properly. And on the other hand, maybe we have to discuss with universities what is the next level of capability, what the big firms are looking for. Otherwise, we will see that this young generation will have a problem to find an entry job.
It was a comment I had in the presentation. We see, and that is also a clear message from market participants, from universities, there is a big gap in education. Yeah, I think that's in Germany, let's say the existing real asset people are not there yet to really understand. And on the other hand, young people are coming in with a potentially change profile, more a digital person with an IT education background, AI background, to integrate that. I think because we are talking just a different language, and bridging this gap and educating, upskilling the existing people in the industry, that's a big challenge. And we don't have the program, at least in Germany. I'm pretty sure a lot of industry players are complaining that universities or other institutions should focus on that, because it's so fast growing. So people need to understand and it's about sustainability, where we have a longer journey, but still we are not there. And now, of course, with AI and digitization.
Okay, good. I just wanted to pick up one of the things that obviously was talked about endlessly 4 years ago and less so now, financing, refinancing. What's the situation here? And then I want to pick up on how that also plays out in terms of some of the sectors, looking at office, especially here in Frankfurt, but also how that's seen across Europe. Maybe let's just start with you on that, Andreas.
Okay, what's our view on that? If we see, or coming back to what we've already said, it's not just a market cycle, it's a shift in the question on how do we run business and what is the business model of Germany, which then the real estate sector provides simply spaces to work in. So knowing that, we've seen we are at record highs for refinancing on a global sector, especially in Europe, 3 to 4 times the average. And that has been in 24, 25 minutes. Now, it's been fully passed out in 24, 25, simply because there was no functioning market of market participants saying, okay, what am I going to do with that commercial space that is now obsolete? So it all ties back together. And then from the regulatory perspective, a bank that prolongs an existing loan may rely on the old valuation as long as it doesn't have new evidence. Now, as the market was not functioning, the banks could prolong those loans, even if they were in soft breach, without having to revalue the assets beneath. That led to kicking down the can now for 2 years, and it's piling up more and more because we haven't seen those refinancing. And the question is this not going to be cut down in 2026 or not? Our assumption is it will be, because it's going to have a direct effect on the capital of the banks. Because now, as the market is picking up, there is evidence, and then there's the need actually to act.
Yeah, I had a discussion some days ago, and they said it shifted from amend and extend procedures to amend and pray, yeah, for the next year. So what I have heard is, and I'm just doing some research on the figures, that over 100 billion have to be refinanced until the end of next year in real estate in Europe. And I'm not sure if that is housing or smaller loans or bigger loans. I'm on a research, so if you have any numbers on that, let me know. But I think this can become a hurdle, because if you want to refinance, maybe your property value is lower than expected, maybe the bank's LTV is lower than expected, and maybe you cannot find an equity partner which is helping you. And this can maybe a new risk for the next year. Yeah? I don't want to paint the devil at the wall, but we should be careful and should be helping also the banks to make sure that all the data they want to see are ready. Yeah. So make sure that you are in a good discussion, and some banks I think will prolong because you are in a long business trail with them, but you will definitely see some risk.
So does that mean that we will see more of these assets portfolios coming to market in 2026? What's our...
I think two things. We were discussing now, to my understanding, the demand side, and I fully on the right. There's a big, let's say, wave of refinancing, could be prolonged again. But I think, as I said, I hear that banks are willing to do some more active workout. So the supply, so the demand side is clear. There is a big need. So on the other hand, the significant shift I see, and we had the panel discussion. We had one MD from a debt fund here. PE backed, there is a clear supply side change. So the banks are focusing, that's a trend we see for quite a while, on the lower LTV institutional capital. So talking to a big German fund, they would say, yeah, we refinance with banks. Yes, but up to LTV, I don't know, 40, 50 with the lower risky assets. And on the other hand, the transformation piece, the developments piece, that's where the debt funds are coming in. And we are talking debt funds for quite a while now. Some are facing issues, doing only the higher risk mass piece. But now we see big private debt funds also able to do the whole loan because they are partly backed by insurance money. They integrated in their group already, so they can really, of course, at a higher margin. They are not the 100 bips margin, which is more the lower LTV thing. They are at a 300 bips point probably, but which is still attractive for value add investors. I would love to hear from Dominik how you see that. It's about the value add and the opportunistic and the development space, where the sentiment is that these funds are really willing to do this business because they take a bit of risk. Yes, they do a bit more return. And one more coming from the US, where debt fund is private debt is a big growth topic. Yeah, there was a discussion about management buyout financing in the US already. They say if you go out with 100 million loan request in the US, you can get 100, 200 offers from debt funds. So it's highly competitive. Real assets, it's also coming up. In Europe, we are still not there yet, but debt funds are definitely highly interested with the pressure from the Americas that you have to show volume here also in Europe, of course, at the higher risk space.
It's good to hear that you have some debt funds or you have spoken to some debt funds who are only looking for 300 bips margin. I haven't seen one yet, so maybe we need to have a conversation later.
The big question is, what is the entry level? So what is now the asset pricing from the current holding structure to the new holding structure, given those market sentiments that we've talked about, those shifts, as defining the new entry level? Because, I mean, if we are honest, there is quite some real estate out there where equity is gone, huge part of the mass is gone, significant part of the senior is gone, if we now reprice it. So how do we come to that point when there is the harsh reality faced to say, okay, we are going to start, because once we start, let's be clear about that, there is market evidence, then it has to be going through the portfolio.
Absolutely true, and that's where I look at the standard setters, and I think we have to go through this phase. Yeah, we can't pretend that we can hope that markets are picking up, so the pain will not be as big as we hope, but we have to go through this phase.
Yeah, when it comes to standard setters, I must say, since the beginning of the year, every valuer has to explain what ESG means for the property in their reports. Yeah, so it may be not impacting the value at the moment, but they have to explain. That makes it a little bit more transparent what's upcoming. On the other hand, I must say, the markets have a different pace. We have seen really good movement in the UK and the Netherlands, but in Germany, so I think some of those who could do a little bit more are feeling comfortable in the actual situation, and they can maybe add 2 or 3 years to this. So we will see only those who are really under fire, and it could take maybe a little bit longer. I was asked how long, yeah, and so my perspective is that it is lower for longer, and maybe we have to wait till 2030, yeah, when we are back.
2030. Oh, I remember when it was 26 and heaven in 27, but now I might have to wait till 2030. It's getting further away.
You know the speech, it will be dirty till 2030, yeah. But
I
this
like
is
that.
not my
That's good.
opinion. We can do a lot in the time between now and 2030.
So let's focus on what we can do. Let's look through briefly some of what we're seeing as the outlook for some of the key sectors. We talked a little bit about office. If anybody's got any questions or anything they want to address on office, let me know and we can pick that up. But obviously, living is a huge part of the sector in terms of, when you're looking at the sentiment surveys. What are we seeing there? Let's pick up from your side, from the sort of value, opportunistic kind of side, the sectors that you're looking at, Dominik. How do you see those? What's the outlook for next year? Are you seeing increasing demand? Where's your view?
I mean, happy to elaborate on that. I already mentioned that we're focusing on sectors where we see a lot of demand, obviously, and a big supply and demand imbalance, mainly in residential, but also in infrastructure type assets like digital assets, but also healthcare assets such as ambulatory care centers that are we definitely need in the future, but it's still very difficult to bridge that gap between the expectation of the capital that's available and the returns that you can make in these assets. That said, I mean, people need to recognize that the assets we're looking at, it's a very low risk return profile. Yeah, it definitely offers very sustainable income, and you need to adjust your expectations to that. I think that needs to happen. What is happening, what we already see is a sentiment shift and a sector shift from institutional capital going away from, shifting away from traditional asset classes such as office and existing residential, mainly to do with ESG credentials that you just can't offer. So the exit uncertainty they have with existing residential. So they need to move into these new asset classes, but at the same time, they need to accept that they need to develop to hold, for example. They need to accept new strategies. Yeah? And that's it's an educational process here in Europe. These are kind of strategies you have seen in the US or in the UK for many, many years, and they just do not exist here yet. It's also to do with regulation of institutional investors who just can't do these type of deals. But I think there we need to see a bit of change to get this moving.
And obviously, housing, affordable housing, but housing generally, huge needs. Whenever I'm in any country, one of the top things that they said is we're supposed to have this amount of housing and we've only got this, and we're supposed to be doing it at this level and we're not. So do we see that as something that real estate investment will get closer to solving in 2026? Do we see us heading in the right direction with that? Is that an opportunity?
I mean, housing has gone through its trough. We already see that cycle ticking up again. I think in the housing market we have seen the worst. I think that's over. So cycle-wise in residential, we are in an upswing already. We see a lot of rental growth still, which helps a lot. Construction costs have stabilized. Yields have stabilized at a surprisingly low level for prime products. So that's all positive. So we see, but there's still a lack of product, a new product coming to the market. And that has to do with availability of land. It has to do with a slow process and planning. It has still to do with construction costs and so on. So that's something where we're trying to address with our land development group, but we're also trying to address with our development group or opportunity group, trying to attract capital to these kind of strategies. What I find surprising, I mean, if you look at other jurisdictions, other countries within Europe that have, found a successful way to invest in these sectors, Switzerland is a very good example in my view, because investors have accepted that they need to create these assets. So, Swiss institutional money is stepping in very early. They're saying, okay, I'm looking at a stable asset class. I'm looking at something where I have no leasing risk whatsoever, but I'm willing to take some sort of development risk in an asset class to get to a higher yield that I then keep in my portfolio for the long term. I think that's a good example of how German institutional capital has to adapt.
Okay, good. I'm going to make sure that we've got time for networking and things afterwards. But I just want to pick up on your views on, let's say, logistics. We've seen an increase in retail over 2025, interestingly, and more of a focus from investment managers that we hadn't seen before, looking at retail. And also, how do we see things like the crossover between infrastructure and real estate? Are those opportunities that we're going to see the real estate side taking more of in 2026? How do we see that? Anybody can pick those up.
I can just start. We have seen this crossover trend from real estate into infrastructure for quite a while now, and it's doing well. And we picked up sometimes, of course, it's in a fundraising mode. It's just to color my real estate more towards infrastructure, because capital raising is easier. That's the lowest level. But there's so much social infrastructure. You mentioned hospitality is a big issue in Germany. There's so much consolidation to be done. It's in the past it was always tricky because it's highly regulated. You need so many subsidies, etc. So it's just tricky. Another big piece in the social infrastructure is schools. We have a big issue in Germany getting schools renovated. There's numbers you never know if they're right. 50 billion is something that needs to be invested in. Just being a father of 3 kids in school here in Frankfurt, you can see what the disaster is. Because it's not just about the capital, it's about the capability and the willingness to do something. And and we also see that some funds are picking up the school opportunity. Of course, it's difficult to harvest volume because you always are on a really local level, and this local level is not also clear in messaging. But that's something which is part of infrastructure, social infrastructure. So that's just one example. And one thing is called the big data center topic. It's discussed for quite a while. The knowledge is getting better, but it's still on a lower level. But that's something also which is PE is looking at it, infra is looking at it, real estate is looking at it. So it's also something. Just example, defense is a thing where also real estate players are looking at, because the government is also leasing logistic spaces for a potential case of war, just to have the supply chain and the logistics in. So these are clear crossovers where we, even without the big change, we can still, as real estate, play a big relevant role, because we also own the land. A lot of landowners coming from the crisis, sitting on their land, they are now all thinking about, could I do in my industrial site or on my old brownfield industrial site, can I do a data center on it? That's the thing that's really moving, and that's driving the market currently, and not just labeling it differently, having it easier in fundraising orders.
I think there's one thing to add. Again, we are on the brim of having a new legislation in space, which is going to take away this huge tax barrier that we've seen in the past between commercial activities and leasing and letting. And now on the fund sector, what we can do, we have the ability of pension money investing via funds directly into commercial activities. And so what we can see is, as the real estate sector is getting more volatile, what we've just talked about all the time, the infrastructure part of providing heat source to a district, of providing last mile commercial activities or last mile services to an inner city, That's something where you can combine in the future real estate assets with this sort of infrastructure without risking your tax status. So it's something we are going to see in 2026, coming early 2026 as the legislative part, which is from our perspective going to have a tremendous effect because it changes the way how you can invest in infrastructure. You can get way closer to the asset, and you don't need to split up the value chain as we had to do in the past, but you can have a direct joint venture on a commercial activity. And that's going to be, from our perspective, a huge change.
There will be a lot of capital flowing into infrastructure, definitely, yeah. But we have to have in mind that this capital could also flow into real estate, yeah. I think there's maybe a kind of cannibalism between those two sectors. The investors are looking for stable cash flows, yeah. So they are really looking for infrastructure and long-term contracts. And on the other hand, I think they see a little bit more risk in real estate because of the big transformation which is ongoing. And that means there's lower money available for real estate at the transformation.
There is for sure infrastructure money. I think there is more capital on the infrastructure side than on the real estate side at the moment. And that's why we're trying to tap into that as well. But then there's a mismatch in the expectation of what they are trying to find. And let's take, for example, healthcare as an example. In healthcare, they are looking for sale and leasebacks. They're looking for long income streams, long, resilient, and secure income streams. Now, if I come up with a new product that doesn't exist yet, infrastructure just can't enter into that space. Yeah? And at the same time, the existing assets, such as traditional clinics, are very much in distress. So they can't find product as well. So we really need this kind of getting closer together in terms of strategy and expectation of capital. Yeah. I think that's an educational process or an adjustment of strategy that we will need to see in the next 2 years or so. Yeah. And good to hear that regulation is obviously addressing that.
Exactly. What we can see now in the future is that you can actually combine those things. So it's not either or, but you can build a city quarter with senior living and combine it with district supply on energy for the surrounding city. And that's something where you can actually then leverage on the steady income stream of the infrastructure, being a real estate investor, and just having the best of both worlds. And that's the same that you can pick up then on the medical side, et cetera, et cetera. And we are really on the edge of getting into that ability.
Last question for everybody, which is, first of all, how are you feeling in terms of positive, not positive for 2026 versus 2025? So do you think it's going to be better, the same, or worse? And you can have more than one opportunity if you like, but where do you think the best opportunity is going to be? That can be a sector, it can be a city, it could be both. But it's where do you think the trends are telling us to invest? Where do we think the opportunities are?
I'm a deals personality. I'm in general positive, but based on the facts we heard, I'm more positive for 2026 than for 2025. Yeah, and the things I would if I would have to invest, I would go for the innovation part. So if it's venture or startup, but this transformation innovation part, definitely, I think that's a good space. And the higher risk resi thing, so resi development, whichever, all parts of resi, that would be my personal view.
Okay, good. Susanne?
Yeah, overall, I think that 2026 will be better for Europe, maybe stable for Germany at the same level as we know it today. But there could be some change or some challenge to make it a little bit more worse if we are not able to invest all the money which is now available. We see definitely the chance of a fiscal impact for next year because of all the new money and all the regulation, which makes it easier to get a permission to build something. I hope that the German politics are supporting this more dynamic approach.
Okay, Dominik.
I'm also cautiously optimistic. I have to say, after Expo, I was pretty optimistic because it's obvious that the times of excuses are over. Yeah, I mean, last year, everyone had excuses and left with more excuses. Yeah, now this year around, I think this time the time really changed. There's a lot of capital available, as you just mentioned, that needs to be deployed, and the time of excuses is over. And people need to get moving and need to find a way to get moving. And if we see some sentiment shift also through the infrastructure spend, governmental spend, public money pouring into the market, then we will see a sentiment shift in the next year, I'm pretty sure. The asset classes I focus on, I can't just pick one because I'm an opportunistic guy, so whatever comes up, I will pick. But the sectors I choose are, as I said, residential sectors, modern residential with a focus on senior living also. But healthcare and digital assets is probably what we're looking at.
Okay, great. Christian.
Yeah, from my perspective, it's absolutely the technology sector and the properties for sure. I guess what we should do or what we should think about is we talked a lot about regulations on buildings. We talked about how is it changing, where can we invest the most. I think we should put the person in the center and think about what do the people around need. And this leads me to the space as a service topic and even to the urban context topic that we're having. And I think that the future investment will be around the person and even allowing the person to live flexible, to have, let's say, an ecosystem of experiences instead of a static number of buildings.
So space as a service really beginning to drive how people see that.
At the end, what we see in all the big cities is that there is a demand for that and the technology is there. We have already a solution for them, which is called digital governance. We rely on the core topics of the PropTech transformation, which are digital twins, which are smart contracts and the digital agents. And this operating system can bring together all these people and even create long-term goals for all, yeah, which can fit together if you are able to put the people in the center and deliver what the people need. Yeah.
Okay, great. Andreas.
Well, I think it's going to be turbulent. It's not going to be an easy sail. It's going to be quite rough, but it's going to bring the market finally into movement, which is going to be good. So I'm optimistic, but it's going to be bumpy. That would be my take. And from our perspective, it's the combination of real estate and infrastructure. Really combining thinking those things together, and then combining them with the trends that we've just heard of: senior living, housing, city developments, bringing this together with the last mile logistics. I think that's going to be the aim.
Great, very good. Thanks very much, everybody, for sharing your views. As said, we'll share these and the views of it'll be 40 or 50 CEOs in the next issue. So interesting that will also inform some of this conversation, which will be great. Teas, coffees, more networking is to be had outside. So if you'd got questions that you were dying to ask but didn't have the opportunity or didn't want to ask in public, you can do that immediately afterwards. And just to say thanks very much for everybody for being here, and I look forward to catching you up with all of you in the coffee, and have a great holiday time when it comes. And we all look forward, therefore, to a more positive 2026, although we expect it to be dirty until 2030, it seems. But that's still positive, I guess. So great. Thanks very much for coming, and if you could give a round of applause to yourselves and also the speakers, that would be great. Thank you.